This is InvestTalk. Independent thinking, shared success.
Good afternoon, fellow investors, and welcome back to InvestTalk. It is Friday, June 7th, 2024, and I'm your host, Luke Guerrero, and I'll be here with you for the next 55 minutes to an hour or so. And I want to extend a welcome to all of those who are listening for the first time, and welcome back to all of our listeners who come here each and every day to try and help themselves become a better and more informed investor. Now, to that end, as we always do day after day, we have a mix of educational items, some actionable items, some tips for you that may help you on your financial journey. And we'll go over all of those things. But more than anything, I hope to hear from you. We have some questions ready to play. We have some comments from our YouTube. We really do prefer to hear from you live. So give us a call anytime throughout the next hour of this show at 888-99-CHART. And we're going to dig into the market performance for the day, and we'll dig into a little rundown and preview of the show topics I have for you. But let's get to our first caller question now.
Hey guys, it's Mike from Orange County calling in to ask about Devon Energy. That's DVN. And I'm wondering if you could do some numbers on that and let me know what would be a good purchase point. Thank you.
So Devon Energy is a pretty big name. It's a $30 billion oil and gas name. And so as you would expect, their profitability, their cash flow, pretty much everything is going to be tied to the price of the underlying commodities that they are selling. Now, geographically, they operate only in the United States, oil making up 58% of their revenue, natural gas making up 8%, the midstream segment about 20% of their revenue as well. And their sales growth has been, again, as you would expect, given where the price of the underlying commodities has been moving. From a debt perspective, they have pretty minimal debt, only about $6.4 billion. Their interest coverage ratio is 13 times, meaning they are not levered that much at all. They still have room if they want to take on more debt. They've actually issued some shares in the past 2 years. They went from 400 million shares outstanding to 600 million. We don't like when companies perennially issue shares, but that looked like it was a one-time equity offering. So nothing really big or wrong right there. Now, regarding Devon specifically, they have an interesting dividend payment program where they have a fixed dividend plus a variable dividend based upon their profitability. And so their dividend yield has been kind of all over the place over the past 5 years, from 1% to 7%. Now it's down to 4% on a backward-looking basis right now. Their dividend per share, because of how that program works with that fixed plus variable, can also be all over the place, from 36 cents to nearly $5, actually over $5 in 2022, which was a good year for oil and gas names. And it's projected to be about $1.03 this year. Like any other name within this space, it is going to be, as I've said probably 5 times by now for this question, completely predicated upon the underlying price of those commodities. So, right now oil is seeing a pullback as OPEC supply is set to increase, as tensions in the Middle East kind of tapered off a little bit. There wasn't as much concern after the death of the Iranian president and what's been going on in Gaza and potentially what could be going on in the border with Lebanon and Israel. But coming out of a period where there has been slower economic growth through the recovery, you're seeing interest rates being cut in Europe for the first time in some time. You're seeing interest rates being cut in other G7 nations in Canada. Maybe we'll see some cuts towards the end of this year. As demand picks up, it could be a good time to get into energy names. I think Devon is a perfectly fine energy name as well. Just keep in mind that their dividend is going to be kind of all over the place, a little bit more so than some other names might be. Thanks for the call. Now, we got a lot of ground to cover in the next 45 minutes or so, and here is some of what I have planned, time permitting. My main focus point concerns this topic. Maybe you don't have to follow the Lauded financial guideline rules. If you understand your goals, you can discover which protocols can and can't help you achieve them. We'll talk about the realities of heavy debt and what you can or should do to solve that. We'll talk about financial guidance, personal finance, and financial goals as well. There are about 10 tips that 10 guidelines Morningstar goes over. I will highlight, I think, 5 that are the most important to me, maybe 6 if we can get to it. We'll also be talking a little bit about alternative investments. They've picked up steam in the retail space after being really the darling of the institutional players for the past decade. And so what are the harsh realities you need to realize if you're interested in alternative investments, private assets? What should you know? Because again, one of the most important lessons that we hope you take away from this is you should always know what you own. We'll also talk about the jobs numbers a little bit, probably dig into that deeper next week, but just a little preview for you about what is going on in the economy related to jobs, new numbers coming out today, and what that could mean for the Fed cutting interest rates going forward. And should we have time at the end of the show, we'll talk about how dividend yield, which historically has been a way that people have priced stocks as being expensive or not expensive, may not be the best way to look at it. So we'll talk about some of the research that has come out more recently. And I think that's actually a pretty good segue into our wealth webinar on Tuesday, which is about digging deeper than dividends. Now we're going into a short break, and on the other side, we'll talk about today's market activity. Please feel free to call anytime and leave your question on the InvestTalk voice bank, or call us live now at 888-99-CHART.
The big day is coming up fast. Click the link in this video to register for the new InvestTalk Wealth Webinar. It's all happening online Tuesday, June 11th at 1 p.m. Pacific Time. You are invited to join KPP Financial's InvestTalk hosts, Justin Klein and Luke Guerrero, as they reveal the secrets of quality investing. Learn why it's essential to look beyond high dividend yield so you can build a resilient and profitable portfolio in today's volatile market. Quality investing is the key to long-term success. Justin and Luke will provide insights and strategies to help you make informed investment decisions. Reserve your spot now. Click the link in this video to register for the new InvestTalk Wealth Webinar.
Let's talk a little bit about the market today and this week. U.S. stocks ended lower Friday afternoon. The S&P 500 down 11 basis points. The NASDAQ down 23 basis points. Small caps far underperforming, down 1.12%. Big tech was mostly down. And regardless, the Dow, S&P, and NASDAQ all locked in pretty solid weekly gains. Underperformers included the memes, small caps, builders, industrials, and precious metal names. The relative outperformers, credit cards, insurers, casinos, big pharma. The dollar was up 80 basis points, firmer on both the yen and euro and all major crosses. Gold ended down 2.7%. Looks like crude oil finished a little change, locking its third straight weekly decline. Overall, it was a choppy day of trading today after hotter than expected jobs numbers, which we'll dig into a little bit later, created a slightly more complicated economic picture. And that's on the heels of concerns about slower growth, the slower growth backdrop from earlier in the week. Several potential meaningful catalysts looming over the near term in the form of NVIDIA's stock split. Although it doesn't really do anything in the real world, for some reason, sometimes stock splits excite people. Apple also has a big tech conference next week where they outline software changes. Some speculate that they'll be talking about how they're going to incorporate artificial intelligence into their software, as well as an update to the Fed dot plot on the 12th and CPI. From a bullish perspective, the AI secular growth tailwind with NVIDIA announcing their new Rubin platform pushed it above the $3 trillion market cap mark. Also, Bank of America flagged a productivity tailwind from AI, as did Goldman Sachs, which highlighted expectations for a 15% increase in U.S. labor productivity and GDP from generative AI. Global monetary policy shifts, as I mentioned before, the ECB and the Bank of Canada started cutting rates this week, and an overall favorable flow trend with U.S. equities seeing inflows for the seventh straight week, pushing year-to-date totals to a whopping $108 billion. On the bearish side, there's a renewed ramp up in rate volatility with those differing economic indicators that I mentioned. Jobs print came in hotter than expected. Remember, we're in a good news is bad news environment. Cyclical names still came under some pressure this week as well. And breadth and concentration concerns popped up again as the equal weight S&P lagged by about 1%. as well as AI overhype concerns and AI regulatory scrutiny. I mentioned it before, but it's important to mention it again for emphasis and clarity. Next week, big week. PPI on Thursday, CPI on Wednesday, and Fed meeting minutes on Wednesday as well. We certainly know what the rate decision will be. It is a 99% chance that they hold it steady. So we will be looking to see what the comments say about the most recent data. Why don't we take a live call from Alabama? Jeffrey, he's looking to own, calling in about SNA. Do you own it or are you looking to buy it?
Yes, sir. Good afternoon. I was just thinking about taking about a 1% position in Snap-on, and I was going to get your analysis on it.
Sure. Let me pull this up really quickly. So Snap-on engages in tool, equipment, diagnostic, repair, manufacturing. And it looks like it is currently trading at $268 a share. It's a $14 billion market cap company. Let me take a look at its debt picture really quickly. Sometimes my computer works a little bit more slowly than I'd like it to. While we're waiting on that, it looks like their revenue growth is pretty stagnant. They had $4 billion in revenue in 2018. They had $4.7 billion in revenue in 2024 is what they're expected to have. From a profitability perspective, their margins are pretty solid. They've actually been steadily improving since 2020 as well, from 16% to 19.6% last year, and projected to be 21.6% in terms of net margin. As such, their cash flow has been improving. They've actually bought back a good amount of shares in the past 5 years, which is always solid. We do like that, just under 1% of shares. And those earnings projections have been upgraded as well. Now, that being said, we should take a look at what it's priced at. It's currently priced at a 2.7 price to book, 14 times price to earnings. And it's also important to note that it has a consensus hold rating from the 12 brokers that cover this name that I can see. The relative strength is dropping off a little bit, and it looks like over the past year, they've kind of just been stagnant and steady. You know, for me, the one issue here is, given that this is a $14 billion name, this is a smaller name, they have 5% short interest out right now, there's just not a lot of growth. Since 2018, there's been pretty stable revenue, 4.6% annualized over 5 years, and it's actually down a little bit in terms of their revenue growth. Most of that was between 2020 and 2021. So, you know, I like the margins. I do like the margins. You're paying 12 times cash flow for a business that isn't growing much. I would probably wait for the price to come down a little bit. Again, we love the profitability. We love the margins. We love that they're improving, but I just need to see a little bit more growth, especially in this environment. Thanks for the call. Looks like we got another call about ETFs from Craig in Seattle. What's your question regarding ETFs?
Well, I've got a couple of questions. One is a follow-up. Justin actually answered one of my questions 2 days ago.
Okay.
I just separated from my employer. Mm-hmm. Everything I have is Roth. I moved about $700,000 of a Roth 401k into a brokerage link. And since separating, I'm considering moving that into a Roth IRA. Now, he had a couple of questions, and so for context, it's Fidelity. So, you know, I trust them. I wouldn't be moving it anywhere else. And he had talked about how long it would take, you know, to have the money out of the market. And they said about 6 business days, which gives me pause. Now, the question is, having everything Roth, there are two things. I have SCHC now, and, you know, it changes it a little bit because the dividends are not going to be taxable because it's in a Roth, as far as I know. But the performance is not real impressive. And after hearing what you guys have talked about dividends and that kind of thing, I'm not sure it's appropriate for a Roth. But everything I'm reading, people are recommending VIG if you want a dividend ETF. And so I'm curious your thoughts about the comparison between the two and whether or not it's even worth having in any kind of Roth vehicle.
Okay, so just to sum it up, you're looking at the differences between VIG and SCHC, whether or not it would make sense to even have that in a Roth vehicle. Those are your questions right there?
Yeah, those are the two that are in context there. And then I've one more about bonds, but they're all related.
Okay, well, we got to head into a short break, and I will answer your questions that you have presented thus far when we head back. But I think we're only going to tackle this one. If you have another question, please feel free to call and leave it on the voicemail, or maybe call in when Justin's back on Monday, and both of us will tackle it for you at 888-99-CHART. And for all of you, we love hearing from you. We love your questions. Feel free to call anytime. And when we come back, we'll look at VIG and SCHC.
Love today's InvestTalk episode? We want to hear from you. Drop your investing questions in the comments below, and your question could be the star of our next segment. Subscribe and stay tuned to see if your question gets answered by Luke and I. Dive into the comments now and become a part of our next conversation. Enjoyed our insights on InvestTalk?
Great news. Our podcast is available on all major platforms.
Make sure to subscribe wherever you listen to your podcasts.
And get the latest in investment advice across Spotify, Apple Podcasts, and more.
Subscribe now and join our community of informed investors.
So before we headed to the break, we had a call, and Craig was talking about within his Roth account what my thoughts were on SCHC, which is the Schwab International Small Cap Equity ETF, or VIG, which is the Vanguard Dividend Appreciation ETF. So first, taking a look at SCHC, it's an international small cap fund. Historically, or at least over the past couple years, that's what I meant. Over the past couple of years, international returns have been lagging U.S. returns, and that's because there's been this asymmetric recovery. You see that in the U.S., inflation wasn't as rampant as it was internationally, and we just overall had a easier time given our natural resource advantage over a lot of the world. And so because of that, international stocks have underperformed a little bit. I think this is a good fund to have as a part of your portfolio. I don't necessarily see the benefit of holding it in your Roth, because Roth, things that are held in your Roth portfolio grow tax-free, right? So that is the portfolio where you would want to see a lot of income. And so Craig mentioned that we've been talking about dividends frequently over the past week, which is true. We have an upcoming webinar on dividends. But one of the things that I've been saying, and one of the things we will go over again in this webinar, is that dividends shouldn't be the only part of your portfolio allocation decisions. Now, that doesn't mean it's not a meaningful part of it. Historically speaking, I believe the upper quartile of dividend payers have outperformed. Again, this is going back to 1928. Certainly that's going to be skewed a lot by the high performance of tech stocks within the last couple decades that don't pay dividends or pay very little dividends. But that upper quartile does do very well. But it's important to note that the top 10%, the top decile, doesn't do as well as the middle names, historically speaking. And so taking a look at this fund VIG is a dividend growth fund, which means that they're going to be focusing on companies that have increased their dividend payments for the past 10 years. That's a proxy for growth. That is a proxy for lowering costs. That is a proxy for improving margins. So the way they're constructing this fund, VIG, again, the Vanguard Dividend Appreciation ETF, 6 basis points, broadly diversified across the U.S., is approaching it in such a way that it is actually hitting on the things that we'll be talking about on Tuesday, which are the things you should be looking at when you dig deeper than dividends. They actually exclude some of those top dividend yielding companies. They don't just look at it as a broad number, right? That, oh, this thing is giving me 10% dividend yield. No, you should be looking at growing your dividends. So I do like this fund. I think it would work well in a Roth IRA, just given the tax advantages of that. So thumbs up to VIG, and actually thumbs up to the other fund as well. I think small caps internationally over the next 5 years, given what has happened in the previous couple, this could be a good time to start investing internationally again. Now I want to turn to the KPP Premium Newsletter. We actually have a new section in our newsletter that will be replacing the current market environment section, and that is called the KPP Insights. And that's because from week to week, it tends to be the case that not much changes in terms of the current market environment. And so we want to highlight one topic that could be the current market. It could be what it will be this time around, which is GameStop and meme mania, and really dig in deep on one topic and give our analysis and our opinion. So as I mentioned, this week in the KPP Insights section, we will be talking about GameStop, what meme mania has meant for retail investors, for Wall Street, what it means for market structure, and overall what our thoughts on that topic are. In the stock ideas section, we mentioned 2 technology sector companies. And in the portfolio management section, we touched on 401k contribution management. If you're interested in learning more, visit us at investtalk.com and subscribe now. Now let's go to a call from Tom in Temecula, who has a question on margins.
Well, no, not margin. It's I bought NRG probably at its high, and then it went down a little bit. And I'm just, I'm just wondering, how can I lower that cost basis without selling premium? And avoiding the wash sell rule. Do you have any strategies?
Sorry, how can you lower the cost basis of your entry point without sell? Well, I mean, there's 2 ways you can lower your cost basis. You could sell options. Right? You already hold the stock, so you're not selling naked options. You could sell options. That premium will go back to what you paid for it, right? That's income into your pocket. The other way is to dollar cost average down in the name. So either you got to buy more shares, and that'll lower your overall cost basis, your overall averages, or you have to sell some options if your account is allowed to do so, and that also in a way lowers your cost basis because you are getting income for selling those options so long as they don't get called away. And so net, if the stock isn't getting called away, you have paid less for that position as a whole. Thanks for the call. Now, in the next Invest Talk, we look into the story behind this question. You are contemplating Bitcoin, but how would you use it in your portfolio? What you need to know about the advantages and risks of investing in cryptocurrency. That's Monday, but for now, I'm Luke Guerrero, and I'm ready to take your calls live on 888-99-CHART.
The stock market is constantly changing, and serious investors want a way to get the latest news and unbiased investment insights. Welcome to the InvestTalk podcast.
Do you want to be a part of the conversation? Don't forget to comment below so we can answer your questions on the next InvestTalk podcast. Just to clarify a couple things from Tom's question, certainly there's another option, which is to sell at a loss, but he did mention he didn't want to deal with wash sales. The restriction on wash sales is only 30 days, so you would only have to sell at a loss, hold on to that loss for 30 days, and then you could buy the shares back. And another clarification is just that if you're talking about in terms of your profit and loss, it lowers your cost basis if you write options, but you have to keep in mind that does not affect your tax cost basis. So those are the things you need to keep in mind there when trying to lower your cost basis. Now let's shift gears to our main focus point today, which concerns this topic. Maybe you don't have to follow the Lauded financial guideline rules. If you understand your goals, you can discover which protocols can and can't help you achieve them. So let's dig in a little bit about these financial guidelines and talk about how, depending on what your financial goals and your personal finances are, it could change whether or not you want to abide by them. And so, navigating financial plans oftentimes feels overwhelming for everybody, myself included. And because of this, people can often focus on rules of thumb. But these rules, like any other rules, don't always apply to everyone and every situation. They are models. And just like any models, they are simplifications of reality. So with that being said, let's dig into some of the 10 rules of thumb that Morningstar recently highlighted and talk about when they should and when they shouldn't be used. The first is delay your Social Security until you get more. If you're earning a high salary later in your career, delaying Social Security can increase your future benefits. But not everybody can wait. If you have a shorter life expectancy, maybe you have a family history of having a shorter life expectancy, or you need earlier access to those funds, it may be beneficial or critical for you to start collecting sooner. So delay if you can, but if you can't, that's okay. Secondly, never take a loan from your 401k. This is one of my favorite ones. Traditionally, you should avoid borrowing from your 401k because you'll maintain its growth potential through the power of compounding. But in emergencies or when facing high interest debt, interest rates are higher than they've been in quite some time now. A 401k loan might be a sensible option. One of the reasons, interest rates tend to be lower than market rates. Another reason, especially since you're paying the interest back to yourself rather than to a bank. Third, prioritize paying down your mortgage. This is another one of my favorites. When nearing retirement, paying off your mortgage can definitely reduce your monthly expenses significantly. But if your mortgage has a low interest rate, or if you're far away from retirement, it certainly can be more beneficial to invest your money in higher yielding opportunities. A lot of people are sitting on 3-4% mortgages. Why would you pay that off early if treasuries, short-term treasuries, are yielding 5%? It makes no sense. Just do math there. Another rule is withdraw no more than 4% annually from your retirement portfolio. Certainly, that can ensure stable cash flow throughout your retirement, but if market conditions or personal spending needs dictate a more flexible withdrawal strategy, that's okay. Another one, maximize matching contributions to your employer's retirement savings plan. The answer to this, frankly, is pretty much always, unless you have an urgent financial need that dictates otherwise. But at the same time, if you have high revolving credit card debt, or insufficient emergency funding, it's important and sometimes critical that you build that first. And the last one I want to touch on is that retirement is the end of work. If you're ready to fully retire and have the financial means to do so, great. But if continuing to work will provide financial security or even personal fulfillment, that's okay too. Keep in mind, guidelines are just that. They're meant to guide you. If your personal circumstances differ for periods of time, it's okay to break these sacred rules and do what is best for your personal financial circumstances. We got another live call from Will in San Diego who has a question on ILMN. Do you own it or are you looking to buy it?
Yes. Oh, I'm looking to buy it. I was in it a few years ago, got out of it. Now I think it might be at an attractive price again.
Okay, let's take a look at ILMN, which is a biotech company. I think people know how I generally feel about biotech companies, but I'll give this one a fair shake. So taking a look at its revenue, it's growing pretty well, 6% year over year, and that's pretty well spread out over the past 5 years. So that's a positive one. Now let's take a look at how that translates to the bottom line. Well, they made money up until the end of 2021. They made money. 2022, they were negative 96% in terms of their net margin, negative 25% last year, set to perhaps make 3.2% this year. Their cash flow was pretty good back in 2020, and it started to taper off. It was falling into 2022. Now it's pretty flat. Their debt level is about $2 billion on a $18 billion market cap company. They pay no dividend, and their earnings projections have been consistently downgraded over the past 6 months. Now let's look at how they're trading in terms of their relative valuation. 3.2 price to book, 78 times forward-looking price to earnings. That's just because they're supposed to make money for the first time in a while. For me, again, biotechs that don't make money, even though they made money before, it looks like their primary business is their core Illumina segment. And, I think that genomic biotech certainly has a place. And can be in my opinion, one of the best areas within the biotech space, including, gene splicing and stuff like that as well. I think that's really promising. CRISPR technology, all of those things. But this company's fallen like a rock. It's been falling like a rock. It's down 52%. For me, because of the risk reward perspective, got to take a lesson out of Steve's book here and don't buy businesses that aren't profitable. It may be profitable at the end of this year, but it's not quite there yet. So keep it on your watch list if you really love it. But for me, if it's not making money, it's not for me.
Yeah.
Thanks for the call.
Okay, I got you. Thanks a lot.
Thank you. Now, on Fridays, we generally take the time to fit in a quick rundown of key benchmark numbers, so let me hit you with that list right now. The 2-year Treasury yield was at 4.857%. 16 weeks ago, that was 4.66, and 128 weeks ago, more than 2 years, it was 0.64%. 10-year yield was at 4.416%. 17 weeks back, it was at 4.17%. And 125 weeks ago, that number was 1.762%. Gold was priced at $2,308 per ounce today. 12 weeks back, that was $21.56, and 119 weeks ago, that was $18.06. Silver today was at $29.34 per ounce. Last week, that number was 30.37. 17 weeks back, it was $22.80, and 112 weeks ago, it was $23.94 per ounce. Oil was selling at $75.47 per barrel. 2 weeks back, that number was $77.81. 26 weeks ago, that was $74.30. And 125 weeks back, that was $66.62. The national average for a gallon of regular gasoline is $3.47 per gallon. 2 weeks back, that was $3.60. 17 weeks back, it was $3.10. And 121 weeks ago, $3.57. In California, it was averaging $4.96 per gallon today. Last week, that number was $5.07. 17 weeks back, $4.48. And 108 weeks ago, it was $5.87. For comparison, in the beautiful state of Oklahoma today, gas was averaging $2.99 per gallon. That is $1.97 less per gallon than gas in the state of California. This is InvestTalk, which means we like hearing questions. Let's play another one right now.
Hey, Justin or Luke, Jake here from North Carolina. Again, looking at a super boring company, about as boring as it gets. Crown Holdings, ticker CCK. Looks like a mid-cap materials company. Tanked in February, but missed earnings in Q4, but beat earnings in Q1. So curious as to what's going on there. Looks like it's less than its 5-year average P to E. But I did notice about an 80% debt to asset ratio there, and the earnings do seem choppy. So my question also is a good idea to start building a position at the current price? Should I be worried about that amount of debt and kind of, again, sideways moving earnings? Love to hear your thoughts. Thank you. Bye-bye.
Taking a look at Crown Holdings, coming off that exciting biotech, we're into a boring business, and it is a packaged products and equipment consumer goods materials company. It is a mid-cap, $9.9 billion, and on that $9.9 billion, they have about $7.7 billion in debt. Their interest coverage ratio is just under 3, so it looks like it's not too high interest involved debt. Right, it's 3 times is what their earnings before interest and taxes can cover their interest expense. So that's good. Their earnings looks like they lost money in 2021, and they made $6 a share. Then $3.76 in 2023. They're set to make $6 this year and $6.79 next year. Regardless, their earnings have been downgraded. On a good note, they pay a pretty stable dividend, 1.22%, and they've actually been buying back shares over the past 3 years, down from 135 million shares outstanding to 120 million shares outstanding. We do like that. Their profitability, pretty stable. Their cash flow is improving. But like a lot of material names, they're down on the year, down 10% year to date. So what's striking for me, even though they are trading at a 13 times price to earnings, which isn't bad, 4 times price to book, that's a little high in terms of their asset level, is that their sales growth is not great. 1.5% year over year for the past 5 years. So for me, their net margins are stable. That's good. Even though they lost money in 2021, they started making money again, 5.6% and then 3.7%. 6% is what they're projected to have in terms of their margins this year. Regardless, it's just too much debt for me. They're not overly levered, but they're getting real close. I like their buying back shares, but until they start devoting some of that to paying down that debt rather than expanding their debt profile, they had $6.4 billion in 2021, now $7.7 billion. I would have to pass on this name. I think there are better names out there. Thanks for the call. Looks like we got another live caller coming in right now from Valencia. Richard, you have a question about TOL?
Yeah, and before I do, I just wanted to send my condolences to Steve, his family, and you, Justin, and the InvestTalk family there. He listened to him for a long time, and he was great. And I'm sure he's was pleased, though, with the job that you and Justin are doing to, continue the legacy of the show.
Well, thank you for the kind words. It's been tough over here, but I imagine it's been tough for all of our listeners as well, because we really are, and we try to we say this all the time, but we really are one big family. And I know that while he was fighting the disease, he really was hoping to get back to doing InvestTalk, because it's truly what he loved the most, was helping out as many people as he could. So thank you for the kind words.
Yeah, sure. Wanted to ask about Toll Brothers. Looking at maybe getting a position in it right now. Wonder what you think of the price of it, and actually the future of it as a long-term investment.
Yeah. So it looks like Toll Brothers engages in the design, building, marketing, and arranging and financing for detached and attached homes in residential communities. Home building makes up 99% of its revenue, as you'd expect based upon that description. It is a mid-cap name on the upper end of the mid-caps, about $12.5 billion, and not much debt, $2.9 billion on that debt. On that market cap. So that's pretty good. Short interest, very minimal. They pay a dividend, albeit pretty small. It's ranged from 80 basis points to 1.5% over the years. Let's see how it's grown, though. It looks like it's pretty consistently grown. It was 41 cents a share back in 2018, and then it was 83 cents a share last year. 90 cents a share is what it's projected to be this year. Their cash flow is improving. Their profitability, their profit margins are improving. They're buying back shares. I like all of this. So let's take a look at their relative valuation. It looks like they're only trading at a 1.7 times price to book, 8.4 forward-looking price to earnings. I'm not seeing a lot that I dislike, to be honest. Their earnings have been upgraded over the past 6 months pretty consistently. Again, I just want to highlight it again because I very much do like it. They're a strong momentum name. Their relative strength is high. Their cash flow's up. Their profitability is looking good. They're buying back shares. They're paying down debt. I didn't even mention that before. I like this name. I do like it, and I think it's pretty reasonably priced, especially where demand has been over the past year or so. I think when demand picks up again, I think this is a good name to have. Thanks for the call, and thank you for the kind words. Now let's shift gears and get back to another talking point today, and that is about alternative investments. And so the allure of alternative investments, such as non-traded real estate, investment trust, business development companies, has had a significant influx in capital within the space. In 2023 alone, these three categories raised a combined $55.8 billion, which is a dramatic increase from the $26 billion a decade earlier. This growth is fueled partly by the notion that locking up funds for extended periods can shield investors from panic selling during market downturns, which is kind of true, but potentially leads to more significant long-term gains. However, a crucial aspect, often overlooked by investors, is the difficulty in exiting these positions. The non-trading nature of these assets means that they do not offer the liquidity found in stock exchange-listed investments. Exiting positions often requires accepting substantial discounts, known as haircuts, on the reported value of the assets. Despite offering to buy back shares, some companies are overwhelmed by the demand from shareholders when they are looking to sell, demonstrating this liquidity mismatch. In one instance, Highland REIT had to offer drastic discounts on buybacks. Moreover, the secondary market for these assets, while growing, often sees assets trading at significant discounts as well. All of this should underscore the point that there are real risks associated with illiquid investments. The difficulty in exiting these positions is something that should weigh on investors' minds. There are costs and benefits to everything, and the only free ride in investing, as people like to say, is diversification. So in the wake of outsized returns and institutional shifts towards these, you have to keep in mind the downsides, because this mistake, not realizing, not knowing what you own, can be pretty costly, and these haircuts look good on nobody. Now we're moving into our last break. It's Friday. I remind you that our voice bank never closes, 7 days a week, 24 hours a day. If you want to call at 2 a.m, do it. Or you can call now at 888-99-CHART. Everybody wants a secure financial future, but getting there takes strategy, discipline, and the right information. Welcome to the InvestTalk podcast.
Thank you for watching. Make sure you like, subscribe, and hit the notification bell so you never miss an episode of the InvestTalk podcast.
Hey guys, this is Art from Tucson calling in. I'd like to say, really sorry to hear about Steve. It was a good tribute you had for him on Monday's episode. Really appreciated hearing that. We're going to really miss his friendly voice, his sage advice, years of wisdom. He was a great guy. I'm sure we're all going to miss him. I know I will. Well, while I got you here, I wanted to ask you about Bath & Body Works, Inc., BBWI. Recently had a pullback of about 12%, and then it sprang back a little bit today. Wondering what you think of it here. I've owned the stock before, and I sold it when it was up, and thinking about getting back into it. It's at $46.98 today. Thanks, you guys. Appreciate it. Bye.
Thank you for the kind words. I think, the best way to keep the legacy going is to remember the lessons that he taught everybody and really use them to achieve your financial goals. But let's dig into Bath & Body Works. So Bath & Body Works is a specialty retailer for products that people might use in their bath or on their body. Go figure. And the reason why they dropped off pretty heavily before was that they had a pretty dismal, I don't use that word lightly, dismal forward-looking outlook in February. And so in these most recent earnings, they had better than expected bottom line, earnings. Earnings per share looked pretty good. But their sales dipped, as you should expect, given their outlook was so terrible. So maybe you see some improvement towards the back half of 2024 as the macro picture kind of solidifies a little bit more. But sometimes when these companies come out here and say things are not looking good for us, which, consumers are paring back, and this would certainly be an area where they would do so more forcefully. They wouldn't buy their bath bombs as much anymore. So, sometimes you got to take companies at their face value. I would probably stay away for now. Thanks for the call. Now, before we head off into the weekend, where I hope we all have a very relaxing time, I wanted to touch a little bit on the jobs number that came out today. I'm sure we'll dig into it a little bit more next week, but there was yet another surprise that was released today. The U.S. jobs market demonstrated more unexpectedly robust growth last month, surpassing expectations with an increase of 272,000 jobs in May. This figure significantly outstripped the forecasted 109,000 jobs. And also, hourly earnings rose by 4.1% year over year, which topped previous estimates and indicated stronger than expected wage growth, certainly stronger than the Fed would like to see. Despite these positive indicators, unemployment rate saw a slight increase to 4% from 3.9% in April, making the first rise above this threshold in over 2 years. So, how has this all affected markets? Well, the data has influenced market expectations regarding monetary policy. Initially, there's anticipation that the Fed might cut interest rates later this year due to a cooling labor market, which would support reaching the inflation target of 2%. Do I think that was true? Do I think that a cooling labor market is enough to reach the inflation target of 2%? Probably not. However, this unexpected jobs growth has led to a recalibration of sorts of these expectations, with bond yields rising and the stock market showing some muted reactions. Investors have adjusted their views, now seeing a greater likelihood that the Fed will maintain current interest rate levels beyond September. This shift is underscored by futures data indicating a reduced expectation for rate cuts at all. And this is all a fair interpretation. While the labor market's resilience is promising, it complicates the Fed's path to easing interest rates and monetary policy, especially with ongoing wage pressures that could induce inflation. Wage growth induces inflation. And the Fed's truly looking for a reason to cut. They are. Now, I want to stress again the importance of not looking at any one number or any one time period, but looking at all the data in its totality. And the pattern is clear. The economy and the labor market are generally weakening. Keep that all in mind, because this makes next week even more interesting. Next Wednesday, the upcoming FOMC meeting and subsequently the consumer price and producers price index releases could give us hints of what is to come for monetary policy. We know the rate decision already. We know they're going to hold rates steady, but it'll be interesting to see the comments coming out of the Fed and if they see hotter wage data as a backstep or unimportant to their broader plan. I'm Luke Guerrero, and this completes another InvestTalk program. We thank you for listening, and we encourage you to tell your friends and family members about our free podcast downloads. Get yours anytime at iTunes, Google Play, and Spotify, and be sure to leave us a review and rate us on iTunes. If you leave us a question, we like to get to those as soon as we get them. I hope you've heard that InvestTalk is also available in video form on our YouTube channel. Just search InvestTalk with 2 T's. Independent thinking, shared success. This is InvestTalk. Enjoy your weekend.
Hey everyone, if you enjoyed this video and want to see more amazing content, make sure you hit that subscribe button and turn on notifications.
Your support means the world to us and helps us create more videos that you love.
Subscribe now and join our community of savvy investors.